Hello, this is Cynthia Fick, and this is the September 24th stock market update. Well, as most of you probably know, the Federal Reserve did start lowering interest rates since we last spoke, and they did it by 50 basis points, which was kind of on the high end of what we were expecting. So it looks like that's the start of a very slow movement down in interest rates, which kind of was already happening a month before the Federal Reserve lowered rates. So that should continue. Today, I'm going to talk about, again, what happens in the stock market usually if we kind of get that slow, gradual lowering of interest rates by the Federal Reserve. And we'll discuss something that could be a snag or a fly in the ointment and what we need to start looking for that. So let's start off by discussing. I've shown you this chart before. I think Matt has too, about when we gradually start to lower interest rates. It's good for both the S&P 500 and the NASDAQ and the 1, 3, 6 month, 1 year, 2 year time frame. It's usually really good. So what is one thing that we can focus on to see if that will continue? Because the difference between a cycle of slow, gradual moving down of interest rates by the Federal Reserve versus a quick one is, are we going to go into recession? So what we can do is focus on, does this economy right now look like we are going into recession? So here's some information on that. And this is what we're going to be tracking. The National Bureau of Economic Research, they say basically over the last couple decades, the two measures that they have put most weight in to determine whether we're in a recession or not is number one, real personal income, less transfers, and two, non-farm payroll employment. So those are the two things that they mostly have focused on to determine if we're going into recession. Okay, so let's look at how are we doing right now then in those two factors to see if we might be having a recession, because that's the big fear, that's the big concern. And can kind of rock the market. So let's look at the first thing they mentioned, and that is real personal income excluding current transfer receipts. And this is going back to 2023 through 2024. So here we are. I don't see this, at this point, at this stage of our game, this is not dropping like a rock, which would mean we are going into some sort of recession. So real personal income is actually just making a new all-time high in 2024. Could it change? Could it start to go down? Of course it can, but that's what we're going to be watching. This is what we're looking at to tell us if the economy's kind of going into a recession. The second thing they mentioned that is most important to them are total non-farm payrolls. That's why, a month and a half ago or so, a number came out they didn't like on payroll, and it kind of spooked the market into thinking we're going to have a recession. And you can see here, this is 2023 to 2024. We just made a new time high. So this is the, how many non-farm payrolls are being created, how many jobs are being created. And obviously it's looking really, really good there too. So these are the things we're going to look at. We can monitor this to let us, to let us know if, it looks like we're going to fall into recession. Could this change? Could it drop like a rock? Sure, it can. But again, we're monitoring it, and that's what we're going to be looking for. Another thing we look at when we, wonder how's the stock market going to be doing on into the future are earnings. So these are forecasts of the S&P 500. This is out of Yardeni Research, very well-respected Ed Yardeni, and just looking at forward S&P 500 earnings per share, what they actually are, and that's the blue line, and then what the projections have been. They've been pretty darn close, amazingly. So this is going on into year end 2024. So for the rest of the year, this is where they're projecting S&P 500 earnings to be. Here's year end 2025. And then here's year in 2026. So far, and we're going to monitor this, nothing has changed to make us think that earnings are going to drop down here. Okay, so this is something we can monitor, as well as the personal income numbers that we'll talk about recession, and the non-farm payrolls. So these are things we're watching, but we know usually, historically, good things happen in the stock market when they start to lower interest rates unless we go into recession. So we're going to monitor all these different items to see if in fact it looks like we may be going recession. We do not see that now. We're just focusing on and trading the charts and things that are in front of us right now. So have a great week and we'll talk to you next Tuesday. Bye-bye.